Today we are going to look at two topics. One is the oscillator divergence, and then tomorrow is the budget day. So how to trade on the budget day. Now first we'll go to the topic, which is oscillator divergence. Previously we have had webinars on this. Oscillator is a non-trend system. That is, generally you have a trend systems where we have seen the typical or the moving averages we have seen, then we have seen super trend, then trend line. So these are all trend following systems. So these are all trend following, or breakout of tops and bottoms. They are all trend following systems. In the case of non-trend systems, we have the RSI. Okay. Even then you have the commodity channel index. You have got the CCI. So these are typical then momentum oscillators we have got. So these are all typical non-trend following stochastics. So these are all the non-trend systems. That means whenever it goes to, it indicates overbought and oversold levels. For example, in the case of RSI, it will say that RSI anything above 70 is overbought, and anything of RSI less than 30 is oversold. So typically this gives only an indication that the market does know that anyway. Even through visual, now we know that Nifty has already fallen from 18,000 till recently. It was trading up to 18,200. From there it has dropped by around 800 points. It has come to 17,400. Today it is around 17,625 or so. So that itself very clearly tells us that it is in a oversold condition, right? So we don't need to look at indicators particularly to know whether it is oversold or overbought. But typically this is one of the tools which the traders use to take it, so that they will not get into any short positions. See, even if you are in a trend following system, if it already is in oversold condition, then it is better to wait for the recovery, then go for a sell, because already if it is oversold, if you typically keep on selling at lower levels, then in that case in any spurt probably you will have at least an MTM problem. Okay, even if there is no loss at the end of the expiry period or during a particular time, but you may have still an MTM issues. Because of that, it is better to wait, that even during a trend following system, it is better to wait for a recovery and then do something. Suppose in the case of a selling pressure, as presently it is in Nifty, it is better to wait for some recovery before you go for a sell. So what is that recovery? That recovery will indicate that if it is moving to an overbought condition. In a trend following system, you are in a trend following system, the prices are below some certain important moving averages, but you want to sell only after a recovery. So what you do is you wait for the market to recover closer to an RSI, which could be 60 or at least 60 levels, before you look towards selling, that is selling on the recovery. Similarly, if there is already a bull market and you know that it is a bull mode because of all the trend following systems, then in that case you wait for the RSI to drop closer to 40, if not 30, 40 levels, before you look towards going for a buy position again, so that you are sure that you are with the trend, but at the same time you are given more space for you, so that the losses will be, if at all happens, could be a little limited, or it gives you some time to get out of the particular stock or the asset. So to that extent, RSI is one of the indicators which helps you to do certain things within a trend following system itself. That is, within a trend you are looking for a overbought or oversold to initiate positions along with the trend. So to that extent, RSI's indication of 70-30 is used. But more than that, the importance of RSI as well as MACD, because MACD is also a trend following system, but the emphasis on RSI and MACD is more because of the divergence, which gives you an early indication, an early warning that all is not good with the market, either on the buy side or on the sell side. Now, for example, let us say the price keeps on moving high. Price keeps on moving high, right? This is the price. Okay, After some time, let us say it comes here and then it moves like this. So it is still making new peaks. Now if you see, it is now this peak is still greater than this. But you can see the advances, the rally which is taking place is taking more time to go to a new peak than what was achieved in this phase, right? So more than this, okay, this, let us say this 10 rupees price was achieved in 5 days. The 10 by 5 is 2. But here, let us say you are achieving a 10 rupees price, but it takes 10 days. Then it takes almost only 1 rupee per day. Here it was going at 2 rupees per day. Here it is going at 1 rupee per day, which means that though a new high is being made, that momentum is, the bull momentum is declining. Similarly, if you see on the downside also, the same thing happen. It can accelerate, and suddenly you see, things taking much longer time to go to this. So when it happens like this, that means though it is declining, the momentum of declining is tapering off. The momentum of decline is tapering off, which gives you a warning signal that you can position yourself for the reverse side and you should not be with the market in this particular place. So that means it gives you a signal that no, you did not be with the trend following system at this place, because the momentum of decline or the momentum of rising is tapering off. So the oscillator tells you that what happens to the momentum of the price increase or momentum of the price decrease. How does it show in the chart? It shows that this particular oscillator will show that initially it was following like this, new peaks, new bottoms, as it happens in the case of the price. But here, let us say here the price is making a new decline, right? So here this will not be making a new decline. This may even be like this. This may even be like this. So that means that you are seeing new bottoms in price. You are getting a new bottom in price, but no new bottom in oscillator. Whether we use RSI or MACD itself can be used as an oscillator. So when that happens, it gives you a signal that yes, visually you are able to see that the momentum is declining, and that is being captured in the oscillator by this oscillator not making a new low when the price is making a new low. Okay, so what happens in that particular case? You stop going for a sell, cover your short positions, and then wait for an uptrend, a confirmation before you go long. So that confirmation, you can use the normal pivot break high. You can use the pivot break high which you got here. You can use that pivot break high also, or you can use the moving averages or MACD, whatever system that you are following. A trend following system can be used to position yourself. In that case, your profit is because you are now catching it at the bottom, your profit is likely to be extremely good. So whenever you are making an investment or whenever you are making a trading, you should look for this. So the time frame can be different. What I am observing probably could be in a monthly chart, it could be in a weekly chart, it could be in a daily time frame, it could be in an hourly time frame, it could be in 15 minutes or 5 minutes. So depending on what type of trader, what type of time frame you are using, you should select that particular time frame for that oscillator also. Okay. Now, if the divergence is going to happen in a bigger time frame, that is, let us say, a monthly chart, then it gives a very, very big undertone for the market regarding its bearishness. So more than the divergence of oscillator in a daily chart, it assumes more significance in a weekly chart. It assumes much more greater significance in a monthly chart. In a intraday time frame of 1 hour, 15 minutes or 5 minutes, probably whatever that we see could get over within a day or probably next day itself. So the lasting phase of that particular reversal that happens may not be sustainable, or maybe very short-lived. But if it happens in a case of a bigger time frame, then we need to be extremely careful. Now this we will highlight with for the Nifty chart itself. Nifty, the most worrying aspect for Nifty was that, now if you recollect, first there was an 18,600 like last year, then it came down to 15,200, right? Then of course then there was some up and down movements. I'm not charting those up and down movements, we will see in the chart. But after that, if you see this early December or so, it made this 18,860 levels also, right? So there was a new peak made. There was a new peak made compared to 18,600. There is a new peak made, right? But what happens if you see the oscillator, whether you measure it in terms of MACD or whether you see in the terms of RSI, this I did not go well with the new high in the oscillator. It was a much lower peak in the oscillator compared to the peak that we got in the price, which is a very bearish signal. Okay, what we call is even an ominous signal for the bull trend. Now that only, so when the market started falling, everybody says that it will stop at this level, this particular level. Probably yes, to some extent it stops and then goes up, all those things. But it gives you a feeling that no, why this is happening, how much it is going to fall, how much we should wait, before we go for an entry. So these things normally will come into question when we see such a thing, because of course valuations are there. Nifty could halt at some place at 17,200 or 16,200. That's only time will tell. But what the oscillator divergence with the price showed is that be careful with your long positions. Be careful with your long positions unless you get a reconfirmation in a trend following system and a divergence again, at least in a monthly chart or a weekly chart. In the case of a price versus oscillator, be careful. So that is the first signal. Whether you go short or not, at least wait for the investment. Or if you want to take profit, you could have taken profit. So this is what it is. This is what we are going to show in the illustration. Okay. So let's look at the Nifty chart. So we will now we'll draw the MACD oscillator. We'll saw RSI also you can put. Let's put the MACD because it can be used either as a trend or as a non-trend system. MACD chart. Okay. Now this is daily chart. This is daily chart. I will show you both the divergence which has happened both in daily chart as well as monthly chart. Now let's look at the monthly chart, bigger chart. Okay. Monthly chart. Just see that prices, you can see, so there was a new peak here, right? So there was another peak. I have drawn the trend line. This is a peak which connects 18,600, 18,887, right? But during the same time, you see, when 18,600 was made, okay, here when it was made, you had a new peak here in MACD, okay. But when you see the new peak being made, you can see that the oscillator was like this, corresponding to this. So whereas that was an upwards. That was an upward line. This is a downward line, which shows clearly that in the monthly chart, as a new peak was made, this did not make a new peak. This did not make a new peak, which is a very ominous signal as far as the market is concerned. So we are not at this point of time estimating to what extent the market can fall, because tomorrow the budget is, assuming it's a path-breaking budget, something happens, then probably all these things can change. But we are only speaking purely from the technical point of view, not from the fundamental point of view of what developments can take place to the higher level. But right now, the technical levels are indicating that be careful as far as Nifty is concerned. You should have been careful already. But if not, it is also something which tells you that you need to be extremely careful. And now only way that you can say that, now let us say January month is now closed. So it has to at least get back above 18,251, because if you see the monthly chart, okay, assuming this is only a smaller correction in this overall picture, then on a monthly time frame, then in that case it has to cut this bar of 18,251 for us to know that yes, the bearish situation is over as far as Nifty is concerned. Why we are concerned is because of the divergence between, in a monthly chart, between the price action and the MACD. We can put it in the daily chart also. Just see it in a daily chart. The same thing. Just see. Okay. Same. See this I. Okay. Right, is an upward sloping. Now the same place. More than that, let me go to this. Okay. So this I So 18,096. Okay, 18,096 to this side. 18,096 to this level. What you can see an upward sloping line in the price. The same time, if you see in this case, you can see a downward sloping line, right? So which means very clearly that as new prices, new tops are being made in the price, there is no new top being made here. There is no new top being made here, which is not a good signal. Which is not a good signal for the market, for the market momentum on the upside. So the fall has taken place, but nevertheless, I've already told you that at some stage it will recover in this year, and normally we close a positive on a year-on-year basis for most of the time, 18 out of 22, 23 years. So any lower level of 5% or more from the top is a good level to go for buy. But that does not mean that it will not go much below 5%. It can go maybe even to 10% down on the upside. Okay, from the previous close. That means 18,100 is the previous year close. So this time it can go to 16,200, 16,300 also, and then revive from there, right? So there is always a chance that the fall can be there, and then from there the recovery can be there, so that it can even cross about 18,100, giving you a return. I am only talking at present. In this at present, it looks as if there can be a fall. Now the same thing happened, let us say, for a bullish environment. Now I will remove this. Now when we could have gone long is this. See here, if you see in this place, no, if you see this place, okay, now you can see downward line, right? Here the same thing, when I draw in this place, here we get an upward line. Here we are getting an upward line. Okay, so we are getting an upward line. So that means at this place itself, we know that yes, it looks as if we are going to go on the upside. Okay, because of the divergence. So it is going to give us a very good entry point for a very good rally. So what we need to observe is, as we got this place this year, this particular place, and probably we might have gone long, let us say above this place. So probably this was this is a place probably 15,892 or 15,900, because that also marked approximately 5% from the bottom. So there we would have got 15,892 is a place where probably we would have gone long, and probably we would have exited somewhere here, because this is the place we would have exited 18,137. So by doing this some sort of shuffling within a year, or this one, our return in index can be much higher than being passive totally. Because a passive investment over a period of time in Nifty index over a period of 3 years and 5 years can give you something like 11 to 12% per annum CAGR. That's what we have seen. Now, if you do on a very important strategic places of investment and disinvestment in your portfolio, there is a chance that probably you can gain much more than that. But of course, there is always a chance that you may miss the some rally and such. So you have to be guarded about it, and do that very consistently and professionally. Okay, so now this is the position as far as the Nifty is concerned. So at this point of time, we are not looking, see, though there is some sort of a small, see here there was a Nifty this one, and right now the Nifty, there is no market this one. So this was a close, and here the index is still, the MACD is not showing any big divergence at this point of time. But we need to keep on watching for this, for any big divergence at any point of time, to take a call on when it will move up. Probably, let us see whether we have got it in a smaller time frame. Let us look at it from an hourly time frame, whether we are seeing any divergence. So right now, if you see in an hour, okay, hourly divergence, see at this place, this was a low, right? So this low, and after this there was a low here, right? This is a low here, but here if you see, the MACD did not go this low. I think this low was there, and after that no, the MACD okay, we are not able to see visually. We should be in a position to very clearly identify at this place. We are not still couldn't identify that clearly as far as the hourly chart is concerned. Probably in a 15 minutes time frame we might have got it. See, in a 15 minutes time frame, okay, in a 15 minutes time frame, if you see this was a low, okay, this was some low, okay. After that you can see that there was a low being made, but we are not able to get a new low in the oscillator. So that means it is clearly giving a signal for some sort of an upward movement or a correction on the upside. It's still on the negative side, but it still gives some hope for some sort of a revival, and that is what has happened. So now in this particular case we could have no, probably since this has happened, okay, and this divergence it has happened here. So what we could probably look towards doing this is this, that is on a trend line break of these two. Okay, so this is the trend line breakout that we got, okay, at this place. Okay, so this was 17,560, 562 or 563, whatever it is. So at this point of time, probably we could have looked towards going long, okay. Of course stop losses are always important. So 17,562, 563 is where probably we could have gone long, and right now we will be keeping this particular low as a stop loss. 17,600, probably 17,600 is a place where we can keep a stop loss right now. So this is the this is the approach that you should take for intraday, like intraday type of thing. You can look at, say, 5 minutes chart in that case. Okay, so in a 5 minutes time frame, of course, after it went up, here, see this place, same place in the 5 minutes chart. Here it went down, and after that we had a we could probably go long in any of this particular place. We could go long in this, but after that we need to be careful. So we might have got out of this position here also. But if you see consistently, this place, the trend line comes like this, and in this case the MACD is going on this side. MACD is going on the upside, which means very clearly that we are still looking towards the closing of the short positions and trying to re-enter into the long positions, and in an intraday time frame. What we have shown, the bearish ominous signal that we got in MACD was in the monthly chart, also in the daily chart, which means probably we could be looking for much steeper correction. Now we will look at the same thing as far as the Bank Nifty is concerned. See, Bank Nifty, at least in a monthly chart, has not had that ominous signal as now. If you see, this is still a high, and MACD is also almost at the same high. If you see, MACD is also something of a similar high. So I wouldn't say Bank Nifty is suffering the same way of Nifty. So Bank Nifty is still okay compared to Nifty. But let us say in a daily chart, what was happening in a daily chart. Okay, daily chart, you can see definitely very clearly. Now this is the high, and after this, see here itself, if you see, this is a high. Okay, this is a high, and after this you can see this is a new high being made, but this particular place, you can see, is the MACD is not making a new high. So in that particular case, we need to be very careful and see that we put in a very, very tight stop loss. So what is that particular tight stop loss that probably we can do? We can put in a below any particular low. See, for example, this particular one which we are getting here. So we could make an exit. Okay, so because there is one bottom here, then one top. So lower top, lower bottom. So at least we can make an exit right now, because we have seen a new high which is not corresponding with a new high as far as the oscillator is concerned. So it is time to get out. So we are putting the position here. Similarly, if you see overall, this is a new high being made. So here we see the peaks, and if you see the peak in the oscillator, it is on the downward side. So you can just see with this help of the trend line itself that we are seeing a clear price oscillator divergence. So this price oscillator divergence is what probably could be a very concerning factor. Could be a very concerning factor. And then now subsequently what we have seen is that much lower low. And here we have not seen any MACD. See MACD, this is falling. Here it is a MACD. Then here is a MACD. Here it is falling further. So that means it has not come for any investment position yet. So there could be a chance that it could rally and then fall. And the next fall we need to observe, like how this one we saw. See, this place we saw that it was going down, but oscillator was not going down. So in that particular case, we could be careful, probably to reverse our any short positions here. Right now, the oscillator is not offering any. The oscillator price divergence is not happening. That means it is still not something which is an investable thing. Probably some more pain is possible. It's possible. I'm not saying for sure that it should happen, but it's a complete possibility. Now, as much as we use the trend line in the price to identify, we can use the trend line in the oscillator itself to know. Say, for example, let's say this particular one, because now, right? So this fall took place here, right? See, this fall, it has taken place below this trend line in the oscillator, which means itself that at this level itself, Bank Nifty has started to become weak at 41,560, 569. Any break of that, it is very clear that we are going to have a greater problem. So we might not have had a issue on the price side trend line, but it's very clear that on the trend line in the oscillator, we are able to see that that fall should not have taken place, because most of the time the MACD was held by this. See, in all these cases, if you see, no, this trend line. So this trend line, MACD has always been within this trend line. MACD has always been within this trend line, right? So this is the first time that we see this being crossed. This being crossed. So that is the matter. That's the matter for concern. So in this case also, so you can trade yourself with the help of trend line in the MACD itself. See, for example, here, let's say here this particular trend line was broken. Okay, in the MACD. Now, if you see, we'll draw this also. Okay, here also it got broken. Now this was falling. So to where we should buy? Now you can look at the can see. Okay, so when the prices are falling to this particular line, in this particular line, we could probably look towards going for a more going for a buy. So that's what also you can the oscillator normally, we should use these oscillator charts also, and also we should be looking towards the price action also. So a combination of both of this will give you a very good sense of the market behavior and what to expect, because this reversal, whenever it is prices are going up and oscillator is not going up, it gives you an early warning sign that yes, it is going to reverse. Similarly, on the downside also, when it is going to reverse, the oscillator divergence will give an early signal of a turnaround. So watching that will give you an edge in the market, buying, reversing yourself, or going in for an investment even before others could pick it up. So you could have easily, when others are saying bullish, 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 you could have pointed out that yes, but you are talking bullishness, but yes, you see this divergence. So there is a chance that probably the market can fall. So with some reservation and caution, you will be expressing that, but it can turn out to be a fact. Okay. So this is as far as the market oscillator. We will continue with this part again as we go ahead. This oscillator divergence, moving average, Fibonacci. We'll combine all those things and we'll have another discussion. So today, now for the rest of the time of next 10-15 minutes, we'll spend on trying to find out what we can do as far as tomorrow is concerned. Now tomorrow is a very important financial event of the this one for financial markets. It's a budget day. Now, of course, these days the budget, because the indirect taxes are now going into GST, because most of the central excise things have been moved right to GST. We know about it. Not much of tinkering happens in customs duty. So to that extent, there is nothing like on GST side. Okay, so this is taken by the council. So there is nothing that you can expect in the budget as far as GST is concerned. So what are the other important aspects? The direct taxes and the capital gain. So the expectations are in the direct taxes, income tax, there will be some relief, some more relief. Maybe the slab can be raised, exemptions can be increased, housing loans probably it can some more deductions may be given, maybe for education or for loans. So something like that can happen. So there could be some relief as far as the middle income group is concerned, as far as the direct taxes is concerned. Then other is the capital gains tax. I don't think there is going to be any change as far as the capital gains, because market is not sensing any big change as far as capital gains is concerned, because otherwise we would have seen some reaction already happening. So I think mostly these are all some relief here, nothing here. So this seems to be for the direct taxes are concerned. But what is there is probably they will make a lot of announcements regarding the budget outlay for education, budget outlay for health, then probably some more measures as far as digitalization is concerned. So all these things can have very sector specific implications, benefiting certain sectors more than other sectors. So some relief or a lot of see, normally we have seen infrastructure being given a push, because the government normally the expenditure is quite high in order to boost the GDP growth. If that happens, it is good for infrastructure companies who are bidding for highways, for railways, for ports, which in turn has a spin-off effect on industries like cement and steel. So any big outlay as far as the infrastructure is concerned is going to benefit construction companies, construction companies, then or big project companies like L&T, then power companies, then we have the cement, then we have the steel. So there will be focus for employment also. So these can get the benefit because of a higher outlay on infrastructure. Similarly, if there could be a continued focus which could be on the health and education, which also could be another sector which can get some benefit. Then any big relief for income taxpayers, probably it helps to boost the consumption. So consumption companies can also get some benefit out of this. So overall, I think the overall focus will be, if it is on something, then probably we will not see much of a fall in all those things. And so there could be some jitteriness in not understanding about the budget implications, or probably being gung-ho initially and then reading the fine print. So all these things can happen. But so one is that we have seen that probably there could be intraday volatility, but the market could probably not have end-to-end, that is close-to-close volatility. We do not know how it's going to end, unless it is going to be extremely bullish or extremely disappointing. One of that has to happen. Now, there is a chance that even after that happens, probably the next day the market will try to understand the proper implications and recover. So we do not know what's probably in store again on Thursday. So what we have is that only 2 days we have got. That is when you trade tomorrow, we have got Wednesday and Thursday. That is February 2nd is the next expiry. So we have got the February 1st and February 2nd. So how do we trade now? If you see, the volatility is very high now, because general volatility itself is increased, and more so because of budget, the implied volatility is increased very significantly. Now if you see the 17,700 call and 17,700 put, because price is now around 17,665 or so. So if you look at the prices right now, so 17,700 call is 166 and this is 138. Right? So 17,000, am I right? 17,700 call, 166, and this is 138. Now if you do this, then we will be paying. So what does this indicate? This indicates that probably 166 is approximately 300 rupees. So the market is expecting a chance that it could be something like by Thursday the close could be below 17,400 or around 18,000. That is the option implications, is that it could be between 17,400 and 18. That is, it may not cross 18. Probably it's also hopeful that probably even if it goes a little lower, it will bounce back and close above 17,400. That is what the option prices are looking like at this point of time. So we have to, if you go with this particular expectation, anything can happen. So if you go with this, then what we should probably look towards doing this is this. let us say my preference, that is, since if you pay 166 plus 138 on a 17,700 thing, you will be ending paying more than 300 rupees, right? So the 17,700 call, so the break will become 18,000 or 17,400 for a put. And if you buy a straddle, it has to cross 18,000 or it has to not go below 17,400 for you to make money. If you take only 166 rupees on the call side, then it is 17,866. This market is generally looking to be on the downside, as we explained in the oscillator divergence chart. So any uptick probably can get sold also, so we do not know what will happen. Similarly, since if it's come to 17,200 levels, 200-day moving average is there, so it can give support and push it back above 17,400. So anything buying all these things probably could mean that there is a chance that we may waste more money or loss can come, okay? Or probably if it goes lower or higher but settles down closer to 17,700, we will lose very heavily of 300 rupees. So we need to look at a low cost, low risk strategy, right? So the low risk strategy is probably a butterfly spread. So let us look at 17.6, 17.4, 17.2 put spread, because we expect it to close probably not much below 17.4, right? So 17.6, 17.4 and 17.2, what is the price as far as the bear butterfly is concerned? And we will look at the bull butterfly also. You can take one of that according to your view or probably both, okay? So 17.6, 17.4, 17.2, we look at the price. So 17.6 is 97 and that is 45, okay? This is 97 and this is 45, okay, price. 17.2 is 20, okay? So if you do this 1:2:1, that is, you are buying one quantity of put of 17.6, you are selling two quantities of 17.4 and you are buying one quantity of 17.2. If you do this, then this is 45 into 2, 90, right? So this is 97. You will receive 90 because you are selling, okay? You are buying a 97, you are buying this 90, 20. So you will end up paying 27 rupees, right? So you will end up paying 27 rupees and you will have a profit anywhere between 17.6 to 17.2 minus 27 rupees will be your profit. A very low risk butterfly spread that you can attempt. Similarly, on the bull side, let's look at, we don't expect above 18,000. So 17,700, 17,850 and 18,000. So what we will do is that we will buy one quantity of this, sell two quantity of this, buy one quantity of this. So butterfly we have already explained before. So 17.7 call, 17.7 call, 160, 165. This is 96, 165 and 96. So 1 minute. 165, 96 and 53. This is 165, this is 96 and this is 53. So what will happen? 165 plus 53 is 217. 96 into 2 is 192, right? So you will pay 25 rupees. You'll pay. So if you are taking a view that probably it's going to be bullish but not going to be bullish much above 18,000, then you can take this for 25 rupees. If you expect it to be bearish, then you can take that for 27 rupees, okay? But if you're neither bullish nor bearish, but you don't mind about around 50 rupees, expecting that okay, 50 rupees we will spend and see where it ends, then you take both sides, bull and bear. Okay, so this is generally where probably it will help you not to take too much of risk, because during budget time you do not know. So it is better not to trade directionally on the budget rate, because up and downs are possible. So first is to keep quiet, not do anything. That's one thing. Second thing, you still try to take some positions. Then in that case, don't take expensive positions, because market can go up or down and settle very closer to the close also. So in that particular case, because already the markets have come down significantly, right? So last thing 17,000, last week it's 17,700 or 800. So probably there is a chance that it can fall, but not already it has fallen from 18,200. So it can settle down here for some time, take a rest, and then do something like how it oscillated between 17.8 and 18.2, right? So here in this case you take low cost strategy, no, very less expensive strategies for positioning yourself. So I would recommend that you go for a, but because if you do either a call, it is 166. If you do a put, it is 138. Okay, you don't mind expecting that you are taking a outrightly bearish opinion and you expect a bigger fall, then you can take 17,700 for 138 and see what happens. It is up to you. Similarly, you're expecting outright bullishness, then probably you're looking at, then you're buying a 166 call and 117,700 call and you're doing it, it's fine. But if you don't want to spend too much, then in that case you can consider, because there also we do not know about the opinion, right? Whether it's going to go up or whether it's going to go down. But if you take it on both sides, we do not know how it will fare and whether it will become too expensive, whether we lose all the entire premium. So what is the least expensive but expressing your opinion to some extent? Okay, so to that extent this will be quite helpful for you to because if it comes quite stagnant by the expiry day at the same price, you will not lose. Okay, if it ranges itself to some extent, you will still not lose. So you are positioning yourself between 17.4 to 18,000. Okay, that is what the market option says, option price says, for a 52 rupees difference. So and see what happens, right? So this is the strategy that we are replicating now. So if you have in this week we have explained both, in this webinar we have already explained the importance of following the price along with oscillator divergence. So whether it is in a bigger time frame or whether it is in a daily time frame or whether it is in a hourly time frame or 15 minutes time frame, depending on whether you are an investor or whether you are a trader. Similarly, we have also tried to give some strategy for a budget day, because the general expectation will be that there will be some relief for the income tax payers, not much in capital gains tax, but greater outlay for some important sectors which can have sector-wise implications. Now, what will happen after the budget and what will happen on Thursday after the market absorbs all these things, and thus it's very difficult to say. Thursday is the expiry day, so if you want to trade, you can look at this, or you wait for the budget to completely get over. By the time the volatility will drop, then you can make a judgment and do what you want. But as far as the butterfly spread is concerned or spread option is concerned, volatility will not make any difference, because you're buying one option and selling one option. That means you're buying one volatility and selling another volatility. So that means it will not have any implications. But if you're doing only for a call or a put, even if the price moves, there is a chance that probably you will not end up much, because the volatility will start decreasing after the budget. Okay, so with this I am concluding today's webinar. So if you have any questions, please ask. Thank you. So thanks for your participation. Hope to see you again next week with a new important topic, or we will continue with the same oscillator price divergence, as well as we will combine that with moving average and Fibonacci to get into even finer detail for trading, which will be helpful for you. Thank you. Bye.